If you invested $10,000 in Nike 5 years ago, you would have roughly $4,000 today. The stock got killed over the last 5 years. It's down about 60%. It's really, really bad. And I talked about Nike for a while. I even called for $65 3 years ago whenever the stock was being hyped up on YouTube. And again, it was a lot of excitement. I said my price target was 65. To me, it was obvious, but the stock is down a lot since then. And I think it's an amazing time to talk about it again, since a lot of you have been asking me if it's a value trap, if it's a generational turnaround opportunity, and just my opinion in general. So I'm going to talk about it today. And I really hope you enjoy it as always. Now, what really went wrong with Nike is that they underestimated the amount of demand that could potentially come, or they overestimated, I should say. And after COVID, we had the stimulus checks. We had like two stimulus checks, I believe, in total in the United States, and people were collecting unemployment and all these kind of things. So they were sitting on a lot of savings. Okay, what did they do with those savings and stimulus checks? They mostly spent them on buying things they don't actually need, buying things they want, maybe vacations, maybe some kind of things from Elf Beauty, which is why, again, you look at Elf Beauty, you look at Estee Lauder, you look at Nike, they all pretty much have the same chart once they peaked in 2021 and they went down ever since. And they started spending them on all those things, and they were spending and spending and spending and spending. And companies like Nike, Estee Lauder, Elf Beauty, they thought that they don't have enough supplies, they don't have enough inventories to meet all the pumped up demand, and they believed that the demand was actually permanent and it wasn't temporary due to the stimulus checks. So what did they do? They ramped up production and they started to increase inventories, anticipating that this underlying demand will continue. The demand did not continue, and inventories started to skyrocket quarter on quarter from 6.5 billion all the way to $9.6 billion when the stock was trading at about 140, 145. And that's why, to me, it was obvious, because I've been in the market for a while, and I know that whenever a retail company that's selling something that's not really essential is sitting on a lot of inventories and they want to get rid of this inventory, what is the solution? They either have to market the product a lot for them to sell the product, or they're going to have to discount the item because people are not willing to pay the underlying price, and that's why they're sitting on a lot of inventory, or they have to do both. And Nike had to do both. They had to advertise, and they also had to do discounts on the products, which has destroyed their operating margins from 13.6% to about 8.1% as of Q4 of 2025. And unfortunately for Nike, they were also hit very hard by the tariffs, as about 24% of the suppliers and manufacturers of Nike, they are located in China. And we had a massive ramp up in tariffs on China, and they couldn't really raise the price to offset it. So it was eating their margins, and that affected the company even more. So it was just an ugly period, ugly 4 or 5 years for Nike. But maybe this is temporary, and maybe it's going to get better because they have a new CEO and just things are coming up. And you had an investor like Bill Ackman, which he actually purchased a stake in the company, I believe early 2025. Well, he recently sold his stake in Nike. He decided to exit. And the reason for exiting, he said, we underestimated the problems created by prior management, both in our initial due diligence and the impact of actions required to effectuate a turnaround. They believe the turnaround is very, very hard. And he also mentioned a landscape in athletic footwear and apparel that's more fragmented, and it's just much more competitive than it was before. So maybe 5 or 10 years ago, it was really cool to have Nike shoes, and everyone wanted to have Nike shoes. But people right now are a little bit more open to trying something else. They want to try Hoka's. People tell me about Hoka's all day. They like those shoes. Maybe they like Adidas. They like something else. Something that just they want to be different, maybe something that makes them comfortable, not necessarily having Nike and then showing off the Nike shoes. I mean, that was kind of cool, I think, a few years ago, but it's not really as cool as it was before. And you can clearly see it from the trends, where Nike's sales have been flat over the last 3 years, but you have this company, New Balance, NB, has been gaining in sales. You have Deck, Outdoors, which has been, ramping up in sales. You have the Hoka brand has been ramping up. Brooks has been, not a lot, but it has been also ramping up, while Nike has been flattish to even going down. So you're seeing a lot more variety out there in terms of brands, in terms of shoes. I'm not saying Nike don't hold their value and they don't have the kind of things they had before, but it's not really the same. And we can clearly see it in the sales profile. So I think there's a structural change in demand and in consumer behavior, which Warren Buffett said it's extremely hard to predict. Now, looking at the latest income statement, they at least were able to stabilize revenue growth because revenue growth was declining. Now it's at least up 1%. Elliott Hill, the new CEO, he's trying his best, and you could clearly see it. I mean, he's doing it, and he at least stabilized the revenues. Now, cost of sales has increased 6%. He said this is largely due to the tariff impact, which would moderate over time as you can compare them to similar tariff periods, but that's not the case here. And it increased 6%. Gross profits in total declined 6%. But we look at operating expenses. This is demand creation expense, which is mainly sales and marketing. They had to increase it by 13%. So again, we're still seeing the same trend where Nike is having to lower prices. They have to market the product even more just to keep the revenues at least break even. Now, if they did not ramp marketing by 13%, what would have happened to the revenues? Would have they declined even more? So this is not the best turnaround stories that I'm seeing here. I mean, I invested in a lot of turnarounds before, but that's not the numbers that I really want to see. Now, at least they're kind of stabilizing the overhead expense and staffing expenses down 4%. So that's, you could say, somewhat encouraging. It's, getting a little bit better, but still, I mean, marketing 13% with revenues only 1%, we still have a problem here. And I think it's going to take much longer than a lot of people are expecting. Now, after everything I told you about Nike, the structural change in demand and the new brands and the tariffs and everything that's happening, what do you believe Nike stock is trading at after it's down 60%? I would say maybe 15 times, 16 times. I mean, Disney is trading at 14 times earnings. Well, Nike right now is trading at 29 times forward earnings. 29 times is ridiculous for a company like Nike. It used to trade at 50 times because it was a quality company, but 29 times earnings is still very high for a company like Nike. Now, they do at least have a decent balance sheet, about 8.3 billion in cash and cash equivalent. Long-term debt is about 11 billion, but it's not really a big concern. Most of it is maturing, like really long-term, like they only have $1 billion due next year, $1 billion due in 2027, and then it starts in 2030. So they have a lot of flexibility to use their cash position to buy back the stock, which they've been doing, but they also pay a dividend. And right now, the dividend is not well covered. In fact, the dividend yield of around 3% is higher than the free cash flow yield of 1.7%. But I don't believe Nike will cut the dividend because the free cash flow is artificially suppressed on a one-time occasion due to the tariffs and a few other things. But I believe Nike will likely be using the cash position for them to cover the dividend. I would like them to cut the dividend and buy back the stock, but I don't think they're going to do that. And I think the dividend is most likely safe for now. Now, in terms of the upside potential on Nike, it's really hard to predict when margins are going to turn up again, if this is a permanent problem or a temporary problem. I think it's a mix of both. But if we look at the analyst estimates, just to have some kind of a guidance to go by, they're expecting massive growth in earnings per share from a depressed earnings per share of $1.55 up to $5 by 2030, which would be, pretty much returning back to peak margins, returning back to everything how it was in 2021. I mean, if it could take 5 years, I would not be surprised. So this number is possible. I think it's not really impossible. I think it's likely. Now, let's assume that they get to $5 of earnings per share 5 years from now. And the current PE, I told you, is like 28 times, which is ridiculous. Now, if we time it by 20 times earnings, we get about $100 per share. The stock right now is trading at about $54 per share. So that's almost 95% on the upside over the next 5 years. But this is, again, using an optimistic case scenario of 20 times earnings, which I would still say 20 times is somewhat expensive for Nike. And we're also betting on earnings per share, going from $1.55 to $5, this is not a conservative bet. So in my optimistic case scenario, I'm seeing about 100% on the upside. So my conclusion is that Nike is, you could say, much better valued than it was before. I mean, if I was dying to buy Nike, I would buy it today. But Nike would kind of be the last stock I would buy in this market, because you have companies like Microsoft going down, Amazon going down, Meta going down. Why would I go and buy Nike stock? Unless Nike was trading at like $35 and I can run some conservative estimates, and on $35, $40, then it would be like too cheap to ignore. It would just be hard to lose money. But at $55 per share, I think there's still a lot of optimism priced in. And I look at other turnarounds like something like Disney as an example. Disney is trading at like 14 or 15 times, or an 8% free cash flow yield, and it has much better prospects than Nike. So why would I pay 28 times for Nike? So this is my opinion on Nike stock. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.